Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of reopening the economy. And Phil, so far earnings are not expected to be negative, and that's likely due to the trillions of dollars in stimulus and support that we've been seeing. And before we get into that, I want to take a look at our latest COVID-19 data comparing the European Union and the U.S., and it's pretty glaringly clear how we're being outperformed.
Yeah, in a way, you can see in this chart that we've kind of been left behind by a lot of the countries that had stricter lockdowns and quarantines. And there's an interesting piece this morning in the press that just shares Europe has much better mask wearing, social distancing, and that seems to have contributed to them being able to keep the COVID cases down for longer as they've reopened their economies. Because remember, they started reopening in April around about the same time as us. There's a couple of isolated spikes in Europe. Spain and Austria have had little spikes, but they've also been very good. And Germany, a month ago, had a spike as well at stopping those from becoming contagious outbreaks. And I think that's something that in the US, we probably didn't think it was going to be quite as bad in the southern states as it has been. But we clearly have sort of runaway new cases in the US, which is having an impact on the economy. It's having an impact on consumer behavior. And because it's affecting people's confidence in being outside. The good news is the last few days, we seem to have seen a plateauing of those new cases. So still at really high levels, above 60,000. But at least we're not seeing it continue to exponentially increase.
Yeah, well, hopefully it'll be helped out with President Trump continuing to wear masks and taking pictures of it. That certainly is influential, and that's a good thing because maybe we can get this under control if, the southern states follow his lead. Because if we take a look at our next slide here, we're seeing it impact spending and our jobless numbers.
Yeah, exactly. And so the chart that looks at the consumer spending levels, we saw consumer spending drop precipitously as everybody stopped going to work and sort of sheltered in place. And that had recovered really quite well. And that's one of the reasons why the US data had surprised on the upside, so much more than Europe's data, actually. We got to a point where we're only about 5% down normal spending levels. And then the spike in new cases does seem to have had an impact in consumer spending. That's not really surprising because I think the reality of the second case spikes is you're going to have economies shut down for longer. You're going to have more companies not able to get back to work faster. And so you do run the risk now of sort of turning this into, instead of a V-shaped pandemic, a longer-term, more classic recession where some companies are going to go broke, some people are going to lose jobs full-time, and that itself makes people start to save some of the stimulus money for the future, just in case they need it for this rainy day coming up.
All right, and let's take a look at our next chart here with an earnings update.
So the earnings are actually looking like they're still positive, which is interesting because obviously a lot of companies have seen this huge reduction in consumer spending. But the stimulus, when you put it kind of back into people's pockets, the PPP programs, they're helping pay for rent, they're helping pay for wages, earnings margins are actually still net positive. So at the moment, it's not like when we went through 2008, 2009, and there was such big losses on corporates that the actual market-wide earnings went negative. At the moment, earnings are being wound down significantly for Q3, but the expectation is Q2 earnings are going to come in with positive margins. So companies are still actually able to stay afloat throughout this. What's interesting is to look at the banks who have mostly reported now. And we've talked before about the fact that in Q1, they raised quite significant provisions for bad debts. And it seemed to be in contrast to a lot of the other companies that didn't have such big drawdowns in performance. What we can see now, we've gone through a lot of the Q2 earnings, is the banks are actually starting to raise provisions again. And that fits with some of the other data we've seen in terms of bond defaults, company bankruptcies. It does seem like there's a lot of companies that maybe won't make it through the pandemic. We've talked before about a lot of the retail brands, some of the oil drilling companies that are already filing for bankruptcy protection. So you can sort of see some longer term stresses in the system just coming through the financials earnings reports that have already hit the tape.
All right, Phil, thanks so much as always for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.